What if I told you the biggest risk in your next acquisition isn't the financials? It is not the debt structure. It is not the market analysis. It's not even in the operations. It's in the humans. And the most due diligence never looks at it. You can buy a $50 million company with clean books and a strong EBITDA and still lose millions. Not because the math was wrong, because the people were wrong. Today, I want to talk about the $10 million blind spot in mergers and acquisitions and why ignoring human patterns under pressure is one of the most expensive mistakes deal makers make. Welcome to the Kathie Owen Perspective, where we talk about leadership under pressure, high stakes transitions, and the human patterns that quietly shape enterprise value. If you're a founder, acquisition leader, private equity operator, or a board member, this conversation is for you because numbers don't run companies, people do. And when pressure hits, patterns reveal themselves. For over 2 decades, I've worked inside high pressure environments, founder led companies, executive teams, transitions that look clean on paper but feel unstable underneath. My work is not culture consulting, it's not motivational leadership. I specialize in identifying human risk inside high stakes moments, especially mergers, acquisitions, and founder exits. I observe what most diligence processes miss. And today, I want to show you exactly what that is. Most deals don't fail in the spreadsheets. They fail 6 months later. Here's this scenario. You acquire a strong company, financials check out, operations look disciplined, the integration plan is solid, but then the founder won't let go. The leadership team starts resisting. Key operators quietly disengage, and everyone says integration is hard. But that's not the issue. The issue is unexamined human patterns. Traditional diligence evaluates financial exposure, legal risk, operational efficiency. All are important, but it rarely evaluates emotional regulation under pressure, founder identity attachment, entitlement patterns in leadership teams, conflict maturity, hidden loyal systems. And those factors determine whether your integration accelerates or fractures. Here's one that costs millions. A founder says they're ready to exit, and intellectually, they are. But emotionally, their identity is fused to the company. They were the visionary, the hero, the decision maker. Now, control shifts, and something subtle happens. They begin second guessing, hovering, undermining, unintentionally, not because they're malicious, because they're attached. Identity attachment is not a personality flaw, it's a valuation risk. This one is quieter. Inside leadership teams, there are unspoken expectations. I'll be promoted after the deal. My loyalty can guarantees my role. I deserve direct access to the new CEO. None of this is written down. But when those expectations aren't met, resentment builds, performance dips, resistance increases, and it looks like an operational issue, but it's emotional instability under pressure. Before closing a deal, ask if control shifts tomorrow, who struggles the most and how? That single question reveals founder attachment, leadership entitlement, emotional regulation gaps. It reveals where the pressure cracks were formed. And pre-close is where you have leverage. Post-close, you're stabilizing damage. This is exactly why I wrote my book, Human Patterns Under Pressure, because pressure doesn't create new personalities, it reveals existing patterns. In the book, I break down how identity attachment, emotional blind spots, and entitlement narratives quietly destabilize leadership during high stakes moments like mergers and acquisitions. If you're responsible for protecting valuation during transition, this book gives you a lens most diligence processes overlook. It's not theory, it's pattern recognition. Deals are moving faster than ever. Roll ups are aggressive. Integration timelines are compressed. There's less tolerance for instability. And when human risk goes unexamined, enterprise value erodes quietly. The smartest acquirers don't just buy EBITDA, they evaluate humans producing it. Because when pressure hits, and it will, patterns surface fast. If this perspective resonates, this is the work I do. I observe and stabilize human risk inside high stakes transitions before, during, and after acquisition. You can learn more at kathieowen.com. I also wrote a deeper blog post breaking down the $10 million blind spot in mergers and acquisitions. I'll link that in the show notes and description below. And if you want to go even further, grab a copy of Human Patterns Under Pressure, because protecting enterprise value starts with understanding human patterns, not just financial ones. If this episode helped you think differently about your next deal, share it with someone in your network. And I'd love to hear from you. Have you ever seen a deal struggle because people dynamics rather than financial issues? Let's talk about it. All right, that's my episode for today, and I trust that you found it helpful. And until next time, I will see you next time.